I am joined by Joseph Wang of FedGuide.com and Peter Stella, curator of the Central Bank Archaeology and the former head of the Central Banking Division of the International Monetary Fund. Gentlemen, welcome to Forward Guidance.
Thank you, Jack.
Thanks so much for having us, Jack. And guys, Peter Stella, for you guys who don't know, is one of the experts and people that I respect and have followed for many years. He is a top-notch economist and central banker. So you guys want to hear what he says. He has some really, really good insights on what determines inflation and how central bank balance sheets work.
Yes. So, Peter, later on in our conversation, I want to get into the rather stunning losses that the Federal Reserve has, unrealized losses on the Federal Reserve's balance sheet. But first, to start off, take us back to when you first got out of college, you started working at the IMF. I understand you had a glimpse into the relationship between fiscal and monetary policy that not a lot of people get. So take us back to the 1980s and what you were doing then.
Sure. So I came out of Stanford with a PhD in economics. I did my dissertation on credibility of basically monetary policy. And I went to the IMF, and particularly I wound up being in a division called the Special Fiscal Studies Division. And so I was traveling to countries and working on, fund-related programs. And really the fiscal issue was really the primary issue. The monetary was, like the tip of the dog's tail. So what really mattered was the fiscal and how it would be financed in terms of inflation dynamics and things like that. I'd seen this in many countries, and then I wound up being assigned to Argentina in the 1988-89 period. So I was in Argentina when inflation was 195.5% in 1 month. That's not the annualized rate, that's the monthly rate.
Wow.
You would go into a supermarket, and this was 1989. There were no prices anywhere. And my Spanish wasn't that great. I was a little nervous, like, what's going on? So I asked people, and they said, people who worked in the store, they said, we don't know the prices. We don't know the prices until you check out, because the headquarters of the supermarket chain sends down a data file, updating the prices every, 4 or 5 hours or something like that. So, and I think certainly, I think most people would agree, at least by now, that Argentina's problems are really fiscal problems, not that the central bankers don't know sort of what they should be doing, but it's simply outside of their control to deal with those problems. So I wound up doing a lot of work on central bank balance sheets back at that time in the 80s. I wrote a paper later on called Do Central Banks Need Capital, which was a bit provocative, and for anyone, and for the IMF was probably a bit provocative. But it was looking at kind of the fiscal dimensions of the central bank balance sheet. Also a lot of work on quasi-fiscal operations of central banks. And believe it or not, sort of 30 years later, the IMF, and I've been involved now, retired for quite a while, but involved in a working paper that will come out very soon on central banks' quasi-fiscal operations during COVID. So that's kind of a bit of my fiscal monetary interactions background, not from a theoretical standpoint, from just having to confront this over time.
So people often have this idea that inflation is largely a monetary phenomenon. Like in the 1980s, we had monetarists like Milton, Friedman talk about inflation is mostly monetary. And even at one point in time, I believe the Fed tried to change their way of implementing monetary policy to target quantities of money. And that wasn't very effective. And so they kind of moved away from that. And even as recently as the great financial crisis, we've heard people, analysts and economists as well, who have this, monetarist view of the world, seeing that quantitative easing was increasing the money supplies, quote unquote, expecting imminent hyperinflation, gold going to the moon and so forth. And none of that ever happened. And even today, as we see, as the money supply is shrinking, we see people pointing that out, trying to draw some conclusions as to the economy. But it seems like this quantity theory of money has been super effective in understanding the price level and understanding inflation. And so your other viewpoint that it's a fiscal theory of the price level seems to make more sense, especially since, what we see right now, large inflation, has been followed by very large fiscal spending by not just the U.S. government, but by most advanced economy governments as well. So do you think that is probably, how would you reconcile this fiscal theory along with the more, I guess, common sense like view that it's just increasing money, then you would have inflation?
That's a fantastic question, Joseph. Peter, I want you to answer it, but I just want to flag for our audience that fiscal policy is the government. So when they spend more money than they take in, they run a deficit. When they do the opposite, it's called surplus. The U.S. has run a deficit for many years. And then monetary policy is what the Federal Reserve does. So thank you for that great question. Joseph, Peter, what do you have to say?
Yeah, thanks for that intervention, Jack, because it's going to change a bit the way I answer the question. So if you take a look at some of, let's say, one of Milton Friedman's more popular writings, right, made for the general public, it's called Money Mischief. Almost every time that Friedman talks about money printing, he says it's the government that prints money. And I don't think that's an accident. I don't think that's a mistake. I believe you can reconcile sort of the quantity theory of money approach with the fiscal theory of the price level by saying, well, Friedman was talking in a certain, in the 50s and 60s, talking in a certain world of, say, fixed exchange rates, where domestic bond markets weren't really that developed. And he believed, I think, that central banks were merely a kind of a mirage. They were a curtain, that behind the curtain, the government was trying to finance deficits in a very seemingly costless way, politically costless way, by printing money, which means getting the central bank to finance it with money printing. I've also looked at Keynes, one of the Keynes, my favorite book. This is called Tract on Monetary Reform. And again, almost everywhere he talks about money printing, it is the government is printing the money. It's sort of the central bank plays no role in this. The central bank is maybe portrayed sometimes as a valiantly trying to stop the government from forcing it to print money, but basically the ultimate driver is the government. So of course, again, that would be a model where we don't have what we think of as an independent central bank. So I would say moving now to today, and we've seen the quantity theory break down empirically. So the question is, was it wrong or did something change? And I would say the fiscal theory is basically saying, well, it's still right. This is not a new idea. It's still the government that's the driving force. But now the government can finance itself, not only in the advanced countries, but in many emerging markets now, with domestic debt issuance in their own currency. So what does that mean? It means basically, if you will, the government has a larger base of liabilities on which it can default through inflation. So in other words, the monetary base in a country like the US before the balance sheet expansion might have been 5% of GDP, 10% of GDP. Currency is a big fraction of GDP in the US because it's used abroad, but let's say 5% of GDP for a standard country. Now, so to get a deflation, sort of get real revenue from that, you have to have a pretty high rate of inflation. But if you have a long-term government debt, very large bond market like the US, maybe 100% of GDP, then you only need 5% inflation, let's call it surprise inflation, to generate 5% of GDP, let's say in revenue over time. So what the fiscal theory of the price level, in my mind, is simply saying that quantity theory of money is a special case of the fiscal theory of the price level. The special case where in your model or in your economy, the only way the government can finance its deficits is through base money issuance. So the fiscal theory is basically saying, well, it doesn't really, the mix between money and bonds doesn't really matter. It's the sum of the government's money and bonds out there. And now there's probably a lead into two other topics today, because now countries are paying interest on the monetary base, and that can lead to an alteration again of the way you think of monetary policy.
I think Peter's explanation, whereas a government is trying to finance itself and has different liabilities to choose, it can either print money or issue bonds. I think that's a really, really good way of understanding why, in the Great Financial Crisis, when the Fed was enlarging its balance sheet, we actually didn't see tremendous inflation because it was more about changing the composition of the government's liabilities rather than actually creating new liabilities. So from Peter's, what Peter has suggested is that, you're instead of financing itself with bonds, it was basically just financing itself by printing money. So the overall amount of money, quote unquote, wasn't changing, but more about the composition, because in a sense, government bonds are a type of money. Would that be a good, I guess, synthesis of what happened and how this theory would be applied to the past, I guess, 10 years?
I think the validity of the quantity theory came from looking at the most narrow form of money, which is the monetary base, which is a direct liability of the state, either through the central bank or directly by the government. Now, the monetarists talked about larger aggregates, M1, M2, which were liabilities also of the banking system. So how do you reconcile my view and their view? Well, there were these things called the money multiplier, money velocity, that kind of, if you dig into it deeply, established let's say stable ratios between these larger aggregates and the smaller aggregates. So that's how you kind of square the circle. So when I'm concentrating on the monetary finance, I'm not talking about the growth in money caused by banks, right? That has nothing. That's between the private sector. So I was talking about the monetary base. And so now, as we're moving into this, the newer world where you say, okay, it doesn't really matter whether the government finances deficits with these particular type of liabilities, monetary liabilities, or treasury bills, which are very close to money that pays interest rates, or 30-year bonds. But what it enables the government to do, and I think this is important for understanding why certain countries, have problems with inflation and certain countries don't, and that is, if you have a large stock of nominal debt outstanding, coming back to what I said earlier, you don't need as much inflation to reduce the liabilities of the state. So the fiscal theory of price level is a bit like, sometimes they call it a bond pricing equation. So the value of the government's debt is equal to the present discounted value of all the surpluses it will generate in the future to pay off the debt. So basically, instead of having money divided by the price level, like the real value of the liabilities of the government, you have a much bigger aggregate, which would be money and bonds as in that equation, let's call it, as opposed to the typical quantity theory equation.
And I think there's a framework from Stephanie Kelton that is helpful for me and hopefully helpful for some audience members to understand this, that if the government is running a budget deficit, they're spending more money than they take in taxes, they are printing money. And to print money, the old-fashioned style would be to print green dollars, which would be just issuing more currency that can be spent immediately. But the way that the U.S. government is set up is the government has to fund that by issuing, instead of green dollars, yellow dollars, which are treasury bills, treasury notes, treasury bonds, all the way out from 1 month or a few days to 30 years. And I guess, Peter, the theory is that is less inflationary if there's a duration component of the money printing. And do I have that right? And do you agree with that? Do your travels to Argentina and all the countries you worked in for the IMF, does that corroborate or challenge that statement?
So I think the first part is correct in some sense, but what I would say is there's just such a larger demand for, let's say, securities than there is for money, certainly in any advanced country, right? So before people don't realize this, but before the balance sheet expansion, so if we take the Fed's balance sheet in 2008, the amount of currency in circulation was about $800 billion. Maybe the amount of reserves, bank reserves, people probably have trouble believing this, but it was $20 billion. And so people kind of think, oh, the Fed has been printing money and so on. It's not the way to look at it. The way to look at it is basically anyone who wanted physical US dollars got them. I mean, there was no dropping them from helicopters. Basically, you had to pay for them. So the supply of currency was demand determined. And actually, the supply of reserves was also demand determined by the banking system. And it's just a fact the banking system was able to conduct its business with a very low level of reserves. So let's look at it that way. So there was a demand for money. And then there was a demand for, if you want to call it yellow money, treasury bonds. Okay, how did that get into the market? Yes, that's more that the supply of bonds is determined by the government, right? The financing needs. So in a sense, it's sort of the opposite of the way that people tend to think of it. So the supply of money before the global financial crisis, in other words, central bank money, was determined by how much people wanted. If you wanted it, you got it. If you didn't want it, you didn't get it. But the supply of bonds was driven by the needs of the Treasury to finance new deficits and to roll over the old bonds. So over time, that supply grew, and there's a demand at the auction price, right? The government has to sell that debt, and it's bought at the market price. So basically, what I'm saying is, over time, countries have developed the ability to finance themselves through this debt issuance. They had to pay a price for it because they had to pay the going market rate. But once you've done that, and I can cite countries in my lifetime, right, who have gone from absolutely no domestic debt market. In other words, I think what Stephanie is talking about, issuing debt in your own currency, and that's what I'm talking about. So countries like Chile, Peru, Mexico, Israel. If you looked in the 1980s when I was traveling to Argentina, there was no domestic debt market. We used to call this, or the market used to call this, original sin. They could not issue debt in their own currency because they were always defaulting. Well, if you look around now, Peru, Mexico, Brazil, Chile, Israel, they all have quite significant domestic debt markets. It's really remarkable. It took them 20 or 30 years to do that, but they've kind of, they haven't reached where the U.S. has reached, but they've really made a significant achievement. And so, in my mind, the remarkable thing in the macro sense of COVID is COVID was a classic, in my mind, classic fiscal shock. It was a real shock, a fiscal shock, right? So everybody knows governments have to spend a lot more money than we thought 2 months before, huge amounts. What happened in these countries, all these countries that had developed domestic debt markets? Did you see a jumps in inflation? Did you see people panicking and the exchange rate falling? No. In fact, those countries were able to issue debt in the middle of the COVID crisis. Israel issued a 100-year bond during COVID. It might have been dollar-denominated, it might have been in international markets. But the fact is, it's quite amazing. If you think, what would have happened, in my mind, what would have happened in 1985 if COVID had happened? All of the countries that I cited, immediately people would have known they're not going to get any foreign financing. It's a crisis. And there's only one way they can finance expenditures, to print money. So you would have seen inflation pick up immediately. And we didn't see that in those countries. And I think that's remarkable. Now, Argentina is the exception, and I would say, because it really hasn't developed that domestic debt market, and a lot hasn't changed since I was there 30 years ago. So coming back to your question, so what the really important thing that I think of is two things. One is the kind of fundamental demand for securities as the lubrication of what makes financial markets work. And it's not only the government debt market, but private corporate markets feed on benchmarks established by the sovereign. So that basically expands tremendously the cumulative deficits that you can finance without inflation. Okay, because you're not relying just on issuing that green type money where there's a very limited demand for that kind of product. There's a much larger demand. And the second thing that I think is very important in terms of, crisis management is because you have like I said, you have a big much larger stock of debt that you can, I'm putting my, quotation marks up, you can default on with inflation, right? Mm-hmm. So for any given size shock, people can say, oh, the government's going to have to issue more debt and there's going to be inflation. Okay, but the amount of inflation you need to sort of make things square is much, much lower if you have that, I call it the shock absorber or technology to kind of spread out the losses on the financial system. Obviously, we're seeing in the US, some of the banks are making losses on this surprise increase in inflation and the fall in the market value of government debt. But that's kind of a small symptom of what I'm talking about. Is that's the flip side of the coin. Somebody's going to be surprised and take some losses either through inflation or falling prices of bonds.
Just to summarize, so in the past, when governments would finance their deficit by issuing money, well, the demand for money is not necessarily there. If there's not a lot of demand for money, people will get rid of their money and buy stuff, and that's inflationary. But if they're issuing bonds instead, there's more demand for bonds because of the collateral value that you mentioned, but probably because they pay a little bit of interest as well. So maybe that's a little bit less inflationary than issuing just greenbacks, I guess.
Yeah, absolutely. It's, if you look at the tax theory, you multiply the tax rate times the base of the tax, and you have a much, much larger tax base. So you don't have to raise taxes, the inflation tax, by as much to do that. And as well, new issuance of debt, of course, takes into account people's expectations of inflation and so on. So, in some sense, the duration, you take a risk. You take the duration risk, and you say, okay, well, I might be surprised by inflation, but I'm only kind of surprised for 1 year. I have a one year my real return is lower than I expected, but then I buy the new debt issuance, and I'm back to I'm back to expecting a real return after inflation. So part of the important part of the central bank in modern times is to try to keep people from anticipating more inflation than is actually going to arrive. Okay, so basically, you don't want high expectations of inflation because the Treasury is going to have to roll over its debt at very high rates, and then you'll witness perhaps the real value of that debt going up, which is the ex post, you get less inflation than was built into the bond when it was sold, the coupon. I don't know if this is a good place to drop my big thought-provoking remark, but if you look at the real market value of U.S. government debt today, or December of 2022, it's actually lower than it was in March of 2020. So the US government has issued about $4.4 trillion worth of debt since COVID started. But if you take the increase in the GDP deflator, it's about 14%. And the market prices of bonds have fallen. The real market value of US government debt is about $400 billion less than it was in March of 2020. So I might suggest that the US already has inflated away all of the debt it issued related to COVID.
Wow, that's amazing. That's very clever too.
And you don't have to tell me anything about the money supply or anything like that.
So the value of the debt is less because of inflation inflated away, but then the nominal value is also less because interest rates are higher. So the value of the debt is less. But is that a good thing or a bad thing for the government? Because now the government has to finance itself at higher rates.
So it's a good thing. Let's say it's a good thing for the taxpayer as opposed to the government, so that we can feel that it is actually a good thing. So basically, this is basically coming straight out of fiscal theory of the price level. So the fiscal theory of the price level is saying we see an increase in the future value of government deficits from the moment of COVID, right? We don't know what it's going to be, but I think the COVID legislation led to additional spending of about $7 trillion, more than what was anticipated, before COVID. So basically the question is, so the fiscal theory says, to the extent that people do not expect the government to run larger primary surpluses in the future, in other words, surpluses that will be used to pay the debt back, then we'll see the price level jump. Okay, so it's called fiscal theory, the price level, which is a bit theoretical thing. It's like in the model, you would say, oh, COVID happens, the government's going to spend $5 trillion more, the price level will jump such that the market value or the real value of the government's debt will fall by $5 trillion or $7 trillion. Okay. Now, let's say, coming back to the real world, it's not going to be that simple because, well, we don't really know whether the government is going to, generate future primary surpluses. I don't think anybody thinks they're going to raise enough that there'll be no inflation, but they might do something in between, right? And unfortunately, when you're dealing with expectations, we can talk about 20 or 30 years in the future, right? And that gets us in the ballpark of will the U.S. ever solve the Social Security, Medicare structural imbalance? Okay, we've been, in my lifetime, we've been talking about that since one of my professors was advising Ronald Reagan on what to say in his presidential campaign about that. So fiscal theory of price level is saying this is COVID happens, $5 trillion in government spending, no increase in taxes. This means the price level will jump, to bring the value of the debt back to what we expect the primary surpluses to be going in the future. So why I say it's a good thing is, in a sense, somehow the process seems to be leading to one where we won't really need any increases in the primary surplus. We won't really need any tax increases to pay for the debt we issued during COVID, because it will have been inflated away. That's roughly speaking what those numbers would suggest. And that, Joseph is surprised. I mean, I was very surprised to look at these numbers. Now, coming back to this distinction between the price level and inflation. So we know that prices are sticky, and in particular rents, for example, things that are contracted only usually change prices once a year or something like that. So coming back to reality, as opposed to the theory, the price level cannot jump. It's just statistically not possible. So we will see inflation come up, continue to increase if it is a result of this fiscal phenomenon, simply because of the sort of the inertia and the lags that are there in the inflation, the way inflation is measured. But I would also point out that when we think about the market value of the government's debt or the market value of any bond, it's important to keep in mind the bond price, whether it's currently trading above par or below par. When it matures, it will mature at par. So basically, because interest rates have been more or less falling since the 1980s, since Paul Volcker, the market value of the US government bonds is on average been trading above par. In other words, interest rates have been coming down, so people have been making sort of capital gains. That's been going on for a long time. So if you look at March 2020, basically the ratio between the market value of US government debt and the par value was about 1.08. So it was about 8% above par. And now it's about 8% below par. In other words, we've been surprised by an increase in interest rates, as you said, Jack, was suddenly interest rates went up. And so the bond went from 108 to kind of 92 in the 2 years. But the point is, eventually that 92, the bond trading at 92 will rise to 100 whenever it matures. Okay, so that market, that let's say the gain to the government and the fall in the market value will eventually be reversed, as you say, because we'll be issuing bonds at higher interest at par going forward. So it's kind of a one-time gain. And my point is, part of the reason why the market value is below par is because inflation will continue to pick up. So in other words, roughly speaking, half of the gain to the government so far has been from inflation, and half, so it's about 14% increase in the GDP deflator and about 16% fall in the market value of the bonds. But part of that is going to be erased, the market value, as those bonds eventually get to par and the government has to issue new debt at higher rates. But inflation will keep going up. So that will sort of reflect in the end. At some point, we will be able to say, yes, this was the amount of the inflation tax, let's say, that came from the increase that was required, let's say, after the COVID spending that was not covered by future taxes or cuts in spending. So let's presume that going forward, the government will be selling debt incorporating the correct expectations of inflation. So if nominal interest rates, let's say the 30-year bond will now be being auctioned at 4%, that's sort of expecting the real rate to be 2%, inflation to be 2%. So that won't be sort of inflationary or deflationary. What's happened, what the gain is, if you will, is this surprise in inflation. So you could have a surprise deflation, which is costly to the government. In other words, it would have to increase the real surpluses to pay off the debt. So what would be inflationary would be if people lost confidence that inflation was going to come back down to 2%, and the government had to sell bonds at 5% because people expect inflation to be 3%. So that would be a real a problem for the government. In other words, if you look at it from a modeling perspective, it's almost as if that means the government would either have to raise taxes or cut spending to pay that inflation premium, the unwarranted inflation premium, let's call it, or it would have to deliver the 3%. It would have to deliver the higher inflation to meet its budget constraint. So that's why you get into countries where nominal interest rates are very high, And it's very difficult to get out of that circle, that vicious circle. The government has to issue at very high rates, and it can't generate the revenue to pay it, so it basically has to have inflation. Coming back to, I was an intern at the Federal Reserve in 1983, and at that time, Paul Volcker was in power, and the U.S. Treasury was issuing debt at, I think, 12 or 14%, which seems, both of you are young. This must seem incredible to think that this was possible. I had a friend in graduate school who had worked before going to graduate school. He had bought some AT&T bonds, and he lived off the interest when he was in graduate school. They were something like 18% yielding bonds for AT&T, which had a monopoly at that time. So what I said at that time to some people at the Fed, I said, it doesn't make sense if the government, the Treasury, the central bank believes that we're going to bring inflation down to single digits or to 2%, 3%. Why is the Treasury issuing 30-year bonds at 14%? This will be hugely costly, right? Because unless inflation is 12%, if you're selling at coupon of 14%, and inflation comes down to 2%, that's 12% real. That's no country can sort of generate enough revenue in the long run to pay off 12% real bond. Okay, so it's really about this situation, or my remark is really about the surprise element, right? So the surprise fiscal spending associated with the surprise inflation, and that's they've kind of, I wouldn't say taken care of each other. Now, I guess the flip side would be if you believe that we should never have inflation ever, then the U.S. should have been raising taxes and so on, or shouldn't have spent the money. I personally don't believe that would have been a good idea, but you could take that view.
Sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview.
So this surprise inflation shock, and because we have such a large debt base, that was actually turned out to be pretty good. It, as you mentioned, it actually decreased the real value of our debt. However, this is only going to be good if the market, the public, continue to believe that inflation is going to go back under control to where the Fed wants it to be. Otherwise, if the market begins to think that inflation is going to stay high, then we can lead into into the situation you described, where the government would have to continue to borrow at higher rates, and potentially that would be more inflationary. So it's really important right now that the government get things under control so we don't go into that situation.
Just to be clear, that this is, you can't have a policy of basically doing nothing, of inflating away your fiscal deficits, right? I mean, that can't be the policy, and you certainly don't want a reputation for that. Certain countries have a reputation for that. Certain countries don't have a reputation for that. And if you have read, I'm sure a lot of people are familiar with the work of Ken Rogoff and Carmen Reinhardt on debt sustainability. And the puzzle in that, the puzzle that they talk about is, well, why is it some countries can have a very high level of debt to GDP and we don't get a debt default, or there's not a lot of inflation, and other countries have a lot of inflation at relatively low debt. And I think if you look at the structures of the economies and in my view, again, this issue of the development of the domestic debt market has a lot to say, but also about the reputation of the fiscal authorities, whether they will be relatively responsible, right? But certainly, yes, you can't go into you can't have a policy of saying, well, yeah, we're going to run a bigger deficit this year, and well, inflation will take care of it. I mean, because then inflation will defeat you, right? Inflation will rise faster than you can spend. I mean, that's how you get into hyperinflations.
But also the debt has decreased in, I guess, market value a lot. And Peter, you've done some new work about what implications that might have, especially since the central bank has been one of the largest purchasers of securities over the past decade. The Fed, as we've just realized through their most recently filed annual statements, they have an unrealized loss of about $1 trillion on their balance sheet. So what does your work suggest of any impacts, if any, that these unrealized losses have? And what kind of, do they matter at all?
So this goes back to, this work I did in the 80s and 90s, this thing to do central banks need capital. It's somewhat complicated again, but it's actually similar to the fiscal dimension if you consolidate the central bank and the treasury and say, is the government credible? Is the central bank credible? And what is the nature of these losses? It matters if you have a loss because you effectively did helicopter money. That's one kind of loss. This kind of loss is a different sort of loss. But I would say I think, or I'm very supportive of the balance sheet expansion that happened after the global financial crisis, particularly in the mortgage-backed security area. I could go into that if you want, but I think the mortgage market was the housing market was basically in free fall coming into 2008, 2009. The shelter component of CPI went into deflation in 2009, 2010. And we also had mortgage rates were not that low in terms of when you have deflation or zero inflation, a 5% mortgage rate might sound like it's not very high to old people like me, but it's a 5% real when you have 0% inflation. So I was in favor of that, but I really felt that the Fed should have shrunk the balance sheet sooner and much more dramatically than it did. I'm afraid there was a kind of lackluster attempt to shrink the balance sheet briefly, say
before 2020 or in 2021 or
well before 2020. So it could have started 2013, 2014 in my mind. It expanded again around that time. Then there was, again, like a half-hour effort to let the balance sheet roll off in about 2016, 2017. It really didn't get too far. And then 2020, we had this huge, enormous increase. So what I'm saying is, even if you think the increase since, let's call it the COVID increase, in 2020, 2021, it continued into 2022, was justified, you could have been starting at a much lower base, right? You could have had a much lower portfolio of mortgage-backed securities and treasuries entering in. So your losses, and the number is, and this is the number, the increase in unrealized losses during 2022, it's $1.2 trillion. Okay, it's a lot of money. It's a lot of money. About 800 billion were the losses on the treasury portfolio, 400 billion on the mortgage-backed security portfolio. And basically What I'm saying is those could have been lower if you had shrunk the balance sheet coming into 2020. Then in terms of what happened during COVID, I think what was done in March and April had to be done. In terms of the Fed's actions to help the Treasury finance the future spending. I mean, no one knew what was going on, and it's very interesting, by the way, to note that the Treasury's balance at the Fed reached almost $2 trillion during the COVID crisis. So what does that mean? That the Treasury was issuing a lot of debt, but it wasn't actually spending the money yet. And so it was building up a huge deposit at the Fed. So that, I think, was, that the Fed, in a sense, provided outright monetary finance. I know legally, yes, no, that's not right. Peter, you're lying, whatever. That's effectively what happened. As an economist, I'm saying this is what happened. And the Fed had to do that. Okay, it had to do that. But it wasn't that the money was going out the door. It was the government was getting ready. You remember we postponed the tax dates and all. So the Treasury really needed that money quickly. It didn't know how much it would need, and markets were in trouble. So completely okay with that. In the mortgage market, okay, it takes a while to originate a mortgage, package it, sell it as an MBS. That might take 60 days. The Fed entered that market for the 2 months, basically bought every mortgage in the United States that was originated those 2 months. It's true. Okay, it's true.
Yeah.
Now, so that's fine. What happened after that was way overkill, in my opinion. And again, I'm not trying to be a Monday morning quarterback. I've been talking about this since 2014, 2015. The Fed should shrink the balance sheet. We have to have some sort of governance structure that puts pressure on that entity to shrink the balance sheet when it doesn't need to. And I think if we've watched, the Fed guy has watched this over time, Joseph. It just seems to me that, the original increase was, this is temporary. We're going to get it back down to as soon as we can. The amount that, we're going to shrink it to where it was before. Then it kind of jumped up again and became, well, we're going to shrink it, but maybe not right now, and not back to where it was, but where it needs to be now. And it keeps just ratcheting up and up and up. And, maybe from a, certain perspective at the high level management, it's like, well, why should be in a rush to give away this power, this tool that we have that's so wonderful. So there's not pressure like there would be on the Treasury, right? If the Treasury were sort of doing a debt operation or whatever, issuing short-term debt to buy back long-term debt, the Treasury eventually runs into the debt limit and it has to, it's curtailed. There's some mechanism to curtail that. And the Fed, because of its independence, basically can buy every MBS in the world, right? Every Treasury in the world. And
to your point, it really didn't make sense in 2021. It wasn't like 2009 when we had a real crisis in housing. In 2021, house prices were going up year over year about 20%. So there's a
right.
tremendous boom in house prices. There's really no need for there to be additional stimulus. So,
and really a huge part of the Fed's accumulation of MBS during that period was the reinvestment of prepayments on mortgages. Okay, so at the end of 2021, 44% of the Fed's MBS holdings were issued in 2021. Okay, and I think it was I have the number, but it's some amazing amount of the Fed's portfolio have coupons of 2.5% or less. Okay, so what happened? Well, people reacted. The Fed interest rates came way down, and people refinanced the mortgages. They prepaid hundreds of billions of dollars on the mortgages that the Fed was holding, including other mortgages, but talking about the Fed's holdings. And so the Fed bought new mortgages, like reinvested that.
And they got new mortgages. They had, consumers had mortgage at 5%, rates collapsed to zero. You could get a mortgage at 2.9%, 3%. So that people paid back the 5% mortgage. So the Fed got paid back on that, but then they borrowed at 2.9%. And then that got put into a new mortgage-backed security in 2021. And then the Fed bought that. That's what you're saying.
Absolutely. And now when interest rates go up, oh, wow, that mortgage-backed security plummets in value like any regular bond, but also because the duration of the bond goes way up because, Jack, you've figured it out. Who in their right mind today is going to prepay their mortgage that they got at 2.5% or 3% when rates are 6 or 5 or 4? So basically that was a double whammy on anyone holding MBS. But the Fed, in my view, because of the target was to accumulate mortgages on the balance sheet by, say, $40 billion a month. So that basically put the operational people kind of tied their hands. Anybody who wanted to come in and prepay the Fed's mortgages, they would refinance, so to speak. And on top of that, the Fed had to buy more mortgages. So I think that's kind of a signal that should have been a signal. Wait a minute, the mortgage market really doesn't need this. I mean, the more I looked into it, the more irritated I got about the MBS purchases in particular, because effectively the Fed opened the shop window and said, anybody wants to come in and refinance at 2.5% or 3%, 3.5%, I'm here. I'm going to buy that mortgage. And basically, that's the $400 billion loss last year. And that's a loss that, unlike with the Treasuries, so the Fed lost $800 billion on the fall in its value of the Treasuries. Well, the Treasury made an $800 billion gain, right?
Yes.
So they kind of narrow it out. I mean, they kind of cancel each other out from that short view. But when you think about it, so who made the gain on the mortgage-backed securities? Well, it's the people who got the mortgages.
Yes.
And if you look at the demographics of that population, they are homeowners who are more wealthy, have higher income than renters. They are also more, again, who is the subset of homeowners during the COVID crisis who could refinance. Okay, so it's not going to be the poor person who's out of work or whatever. I don't think they were being received with open arms to refinance their mortgages. So if you look at the data, it's very clear that there was a transfer of wealth, let's call it, from the taxpayers in the sense of these losses on the mortgage-backed securities that the Fed is holding, and the homeowners. And Joseph said yes. So it prompted over 2 years of house price inflation. I think at 17% a year, something like that. And now we're seeing in the CPI data, the housing market was in good shape before that, and it's really kind of accelerated. And we're seeing, rents going up. So the latest CPI number, the cost of renting a primary residence was rising at 8.8%. And again, who are the renters in America? By far, they are, the poor part of the population, people without assets and so on. Not everyone, of course, but
right.
If you look at the demographics, it's very clear who is paying the price for, in terms of that inflationary, like who's bearing the burden of the inflation. It's not the homeowners. House prices have gone up.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. So a lot of what was on Silicon Valley Bank's balance sheet, the bank that collapsed a little over 2 weeks ago, was agency mortgage-backed securities, very similar, if not the same, to the assets that the Federal Reserve bought. So it's interesting that despite the Federal Reserve taking on so many of the losses of rising interest rates for itself, it's like, don't worry, I got it. So, there were still many casualties in the private sector, not many, but some significant casualties in the private sector. And now, Peter, you raised a really interesting point about the losses are someone else's gain. If the U.S. government runs a $500 billion deficit, that's a gain for the private sector because the private sector gets to receive $500 billion more than $500 billion more than it pays in taxes. So the losses of the Federal Reserve that are unrealized losses, unlike some commercial banks, there's never going to be a run on the Federal Reserve. Or if we do, Joseph, we're shutting down the podcast.
Right.
But so the losses were the gainers of the homeowners, and in some cases, the gains of the commercial banks who didn't have to hold them on. I mean, it would have been way worse maybe on the commercial bank side. But Joseph, what does it mean for the Federal Reserve to have $1 trillion unrealized loss that it will mark as a, when Peter is saying, it's a drain on the taxpayers, it's the taxpayers' loss to give to these, mostly affluent people who were able to refinance at 2.9% in 2020. How is it that the taxpayers' loss? I mean, who when the Federal Reserve loses money or makes money, how does that even, who is it? Like, who is the Federal Reserve, Joseph?
Yeah, that's a good question. I mean, I can understand in treasuries, like Peter mentioned, someone's Fed is losing treasury gains, so all in all, it's not that big of a difference. But when it comes to things like mortgages, there is a distributional impact because, as Peter mentioned, you are basically subsidizing some of the people who are able to get mortgages and are wealthy enough to own houses, and that's basically subsidized by the public sector. And there wasn't really any reason for that. So I think it makes no sense for the government to have done this. I agree completely with Peter.
Can you tie it together, Peter, where, when Fed Chair Jay Powell goes before Congress, or let's say when he goes to a press conference, someone maybe from a conservative press asks, what do you think about the, Biden administration spending all of this money, and Fed Chair Powell expectedly says, that's not my job. I don't concern myself. I don't make a comment on fiscal matters. That is what we see, what the public sees. But you tie that together with your statement about how monetary authority really can help the fiscal authority, and that during 2020, there was, in your words, a monetization of debt. Sort of which picture is accurate, and could they be compatible in some way?
I think if we come back to the fiscal theory of the price level, people don't think of that, I would say, as a fiscal dominance in the same way as the central bank being forced to print money, sort of fiscal dominance. So I think the fiscal theory basically is pointing to the importance of future fiscal deficits, the government's operations, in a pretty long-term sense, right? Whether you have a credible government overall. In other words, you will allow the way so I've talked a lot about this, in 35 years. The way I've defined central bank independence is the central bank is independent if it can raise interest rates when the government doesn't want it to raise interest rates. And the answer, the sort of the footnote to that is, and governments never want the central bank to raise interest rates because they're a big borrower, right? They don't want the rates to go up. So basically, in my mind, fiscal dominance, if we really looked at it, away from the models, which are quite extreme, is to say that the central bank does not do what it thinks it's right in terms of raising rates because of either direct kind of political pressure, because of the impact on the budget, let's say, or because the government is in danger of getting into an unsustainably high, death spiral. In other words, real interest rates are going to be too high. So they basically give in and say, okay, a little bit of inflation is better than, basically the snowball effect. So I think maybe there's a better term. I don't have it for fiscal dominance or fiscal influence. So if you ask me, again, all of my experience says in many, many countries, you really have to be, have a responsible government in place. But you have an independent institution, and the rules are government doesn't criticize us, doesn't put us under political pressure. So we don't criticize the government, and we don't criticize, the government officials. And that's kind of the rules. And I think that makes sense to a certain extent, okay? But then we get into this quasi-fiscal, what I call the quasi-fiscal. And the question is, can the fiscal authorities, I would say, legitimately question these losses on the mortgage-backed security portfolio? Because, this is something the government could have done. And in fact, the US government, still under the Bush administration in 2008, actually had a program where the Treasury bought agency debt and agency mortgage-backed securities. And when I talk about governance structures, I think this is a very important example. So basically, the Treasury was doing what the Fed later did. But what was the difference? The Treasury or the government had to pass a law. Mm-hmm. There was political heat by the opposition when they passed the law. It's called the Housing Support Act of 2008, something like that. Number one. Number two, of course, the amount that the Treasury was allowed to do was specified in the law. It wasn't an open-ended thing. And of course, Congress had to authorize the spending. This is the legal framework in the US for government spending. And to end this part of that story, when the debt ceiling started to bind in 2010, 2011, under the Obama administration, do you know what happened? The Treasury auctioned off these mortgage-backed securities and debt. So if you say, oh, it's impossible to sell them, well, I'm sorry. The debt limit happened. So the Treasury said, well, I need to sell these assets, these private assets, take the cash and use it, to spend because I can't issue more debt or to buy back debt. So that's an example of, there's one governance structure to do that, called the fiscal structure, to provide, assistance to the mortgage market. I'm not making it up. It was actually employed. And those assets disappeared from the federal government's balance sheet because of the debt ceiling, I would say. Right. Overall, I don't think the debt ceiling is a good thing, but it had its purpose for this case. It forced the government to do something.
To Peter's point, so this action by the central bank, by the Fed to purchase mortgage-backed securities had fiscal implications, and so it made more sense for that to fall under the elected government for more of an accountability framework, as Peter is suggesting. But right now, something else new is also happening, is that the Fed has tremendous amounts of, I guess, a huge balance sheet, and now it's also paying interest on it at very high rates. Now, remember, before the great financial crisis, the Fed had a very small balance sheet, and it really didn't matter what they were paying on interest. But now they have a balance sheet of a few trillion, and as interest rates go to 5% or more, that actually has pretty big fiscal implications as well, right? You're giving money to the banking sector and people who park money at the Fed, let's say the money market funds. Does that mean we have to rethink how we actually conduct monetary policy in this way, since it's becoming more like fiscal policy?
Well, that's a great question, Joseph. But I was go back to, so let's say the Treasury's, the Federal Reserve's unrealized losses. I think Joseph or Peter, you said over $1 trillion. Let's make it $10 trillion. What is the limit to how much pain the Federal Reserve can realize if it never has to realize it? It can always just lower rates and then make it back on a deferred asset. And yes, I guess the proceeds to the Treasury, it will take a long time to fill that hole. But Peter, I just want to expanding on Joseph's question, a $10 trillion, a $1 trillion unrealized loss on the Fed. Why not 10 trillion?
So I think that's very important to ask that question, and I'll tell you why. So in my career, as I think I mentioned, I studied this issue of central bank capital, central bank equity, central bank quasi-fiscal losses. And there, if you Google, my name, central bank capital, you'll come up with a number of papers that I've written or co-authored. And there's no question that there are countries that cannot have a low rate of inflation and a severely negative central bank balance sheet. Okay, so I could list a dozen countries in the 1980s that fell into that category. So what do I mean by that? And coming back to Milton, Friedman, and so on, this idea of the government printing money. How does the central bank monetize its losses? Or it can't raise taxes, right? It can't cut spending. It's got to basically, it has a $10 trillion debt. If it's a 5%, whatever, there's a flow that it's got to be paying interest on that debt. And by the way, there are lots and lots of countries that have decades of experience managing central bank debt, right? Securitized central bank debt. So I've done a lot of work on that. That work isn't in the public domain, but about restructuring central bank's balance sheet, because coming back to that period where there was no domestic debt market in emerging market countries, and you had a crisis, Latin American debt crisis, the Asian crisis, the central bank absorbed some of the money that it created by issuing its own debt out of thin air, right, in domestic currency. So I have dozens of cases of central banks that have been heavily indebted, okay? So the answer to your question is there is a tipping point for every country, and the tipping point is, can you finance the central bank's losses at a low rate of inflation? Okay, so some of them, it's absolutely not true. If I could say it's a nonlinear relationship in the empirics, I have a paper on that. So now we're looking at the Fed, okay? So in 2009, I issued a working paper and I did a little stress test of the Fed's balance sheet, okay? This was before the Fed did publish their own stress test. And basically my point was, even in a really bad scenario at that time with that balance sheet, right? This was the crisis balance sheet before it expanded, okay? So losses there are not a problem for the Fed because there's a big demand for physical currency. There's a big demand for US government debt. And the irony in the whole, the GFC was that although it originated in the US, the best asset class return in, I think, 2009, 2010 was US government securities, right? Mm. So any other country, if the crisis, there's a crisis in Mexico, right? The Mexican value of the debt goes down and people don't want Mexican pesos, right? I mean, it's very counterintuitive. But in the US, there's a global crisis, so people rush and they're ready to finance, they're ready to finance the Treasury, they're ready to hold the Fed obligations. So basically, if you were looking at the question, 1 trillion, 10 trillion, I don't think it's not so much, realized, unrealized. It's really the issue of how is that financed? And as Joseph was saying, basically the Fed is now running cash losses. It started running cash losses in the last quarter, right? So it's paying eventually probably be paying 5% on its repo facility on all the deposits. And it's not getting the coupons, the payments on the mortgage-backed securities and from the Treasury. So it's essentially going to have to print, what we would call printing money to pay for those losses. Now, it's in a sense issuing a security, which is an overnight deposit at the Fed. and paying interest. So then I would say the question becomes, at what point does that cash flow imbalance get to a situation where people say the Fed has to inflate away its own debt?
Right. And so I was under the impression that all of the Federal Reserve's liabilities were pretty much, to use Stephanie Kelton's terms, green dollars, overnight securities. But you were saying that some central banks actually had yellow dollars. They issued their own securities, and then those securities were packaged and securitized. I'm fascinated by that, Peter. I'd love to have you back on Forward Guidance, and I want to check out your paper, and we'll leave a link in the description so people can check it out. But Peter, before I turn to Joseph, who could sort of summarize all this for us, are you saying that the real limitation on the amount of losses the Federal Reserve can take, realized or unrealized, is inflation?
It's basically, let's come back again to the fiscal theory. I hate to keep doing that, but in the sense, and I think Stephanie has also this perspective. So you consolidate the Fed into the Treasury, okay? And then that combined unit is issuing debt to finance its deficits. And can it sustain that given debt level in a non-inflationary way?
Mm-hmm.
Okay, and that's kind of an issue about the real rate of growth and the real rate of interest and so on. And if it can't, there will be more inflation maybe than we would like. But I think in the U.S., we're very, very far away from hyperinflation or getting so out of control. And I think it's also very important to consider why I think from a coldly analytical, empirical data standpoint, the COVID crisis was what people tried to model, in theory. It's like a surprise shock. It's very difficult, right, to have something like this. And I think in some sense, COVID was literally, it came out of nowhere, and it has a huge fiscal cost. And I think, in terms of being able to draw lessons from it, it's very important. But I think that's different than looking at the sort of steady state relationships. You see what I'm saying? This was, to me, it was like, were there shock absorbers in place to handle this in a non-inflationary way? And I would say, again, talking about all these emerging market countries, yes, they had inflation. Yes, the U.S. had inflation, but I think it was pretty decent. It was a good outturn. Right. Yeah. But if a country were to have repeated shocks the size of COVID, that's when you would run into this. You would eventually run into the problem, I guess, is what I'm saying. So if COVID had been a $10 trillion shock, I think we could have. If the losses had been $10 trillion, I'd have to know, how we got there.
Right. It's path dependent. That's really interesting. Thank you, Peter. So,
sure.
Joseph, over the course of this interview, we've mentioned many excellent books. I would be remiss if I didn't include Central Banking 101, which is the excellent book that you have behind you on your wall, of course, written by you. Joseph, Peter is extremely brilliant person. So this has kind of been Central Banking 202 or Central Banking 303. Could you sort of bridge the gap and help me and maybe our audience understand? Could you summarize the fiscal theory of the price level and sort of give us a takeaway from this conversation?
Yeah, I think Peter has a joke oftentimes. He mentions at the IMF that the nickname was it's mostly fiscal. So when we think about inflation over the time, it's not just about monetary policy, and it's not just about central bank's balance sheet, but we also have to focus on what the fiscal authorities are doing. So what's the government debt, for example? How much are we spending? So I think that's a really important lens to understand the world, because over the past few years, we've seen this huge jump in fiscal spending and also a huge jump in the price level. And if we look at current government estimates of what the fiscal spending will be for the coming years, it's also going to be very high. So this additional lens, rather than just looking at money or looking at central bank actions things, I think it's really useful. And I really encourage everyone to read Peter's work to learn more about it. It's been very helpful for me. And I think it's a very good theory in understanding the world.
Yeah, and I want to ask the question real quick. We only got a minute or two left. Does this validate or challenge the thesis that eventually the Federal Reserve will have to pin yields at 4 or 5%, because if yields went to 7%, we would get into sort of to a death spiral?
So I think there are more clever ways to solve that problem. I don't want to talk about them actually, but I think we won't come to that. In other words, that's what we had during the Second World War and the Korean War. I think there are probably more clever ways to solve that problem.
Got it. Thank you, Joseph.
Yeah, there are definitely more clever ways to solve that problem. Sometimes I don't know if we have clever people running the banks though. So it seems like a path of least resistance. It's already socialized in the marketplace, so to speak, being used by big central banks like Japan and Australia in the past. So I think that's a reasonable possibility. I think honestly, I would bet on it.
There we go. Well, everyone should check out not only your book, Joseph, Central Banking 101. You have a piece on fedguide.com called Ameridollars, which is related to this MMT adjacent theory of you can only default on a currency that is not the national sovereign. Peter, people should check out all your papers, which we'll make sure to include a link in the description. Your work on centralbankarchaeology.com, folks should check that out. And on Twitter, you are at stellar_consult. Gentlemen, thank you so much. And thank you everyone for watching. Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.